In this video, I will share everything you need to know about the heiken ashi candles. By the end of this video, you will be able to identify high probability trade setups using the heiken ashi candles. A quick word before we start. What are heiken ashi candles? The word heiken ashi means average bar. Heiken ashi candles use the concept of averaging to smooth out the price action and give us a better understanding of the market trend. The close of a heiken ashi candle is calculated by adding the open, high, low, and close of the current candle and then dividing it by 4. The open of a heiken ashi candle is at the midpoint of the previous candle's body. Using these two averaging techniques results in a clearer and cleaner picture of the price action. Here is an example. On this chart, we have the regular candlesticks. We can see that the candles are pretty much mixed up. We can see red and green candles everywhere on the chart. Now, here is the same chart with heiken ashi candles. Here we can see a cleaner price action. During up moves, we mostly have green candles, and in down moves, we mostly have red candles. So, this is the advantage of using heiken ashi candles. If you are finding value in this video so far, then hit the like button and subscribe to our channel so that you never miss our new videos. How to read heiken ashi candles. Heiken ashi chart reading is pretty simple and straightforward. On the heiken ashi charts, we basically have 3 types of candles. A bullish candle is a green candle that has a green body and an upper wick. The bullish candle will have a tiny lower wick or none at all. Such candles are a sign that the price is in an uptrend. Then we have the bearish candle. A bearish candle consists of a red body and a lower wick. It will have a small upper wick or none at all. These types of candles are a sign of a downtrend. Lastly, we have doji candles. These candles can be green or red. A doji candle has a small body and large wicks on both sides. We have upper wicks and lower wicks that are almost equal in size. This is a sign that the existing trend is exhausted and there is a pause in price movement. Using these 3 candle types, we have formulated 5 signals on the heiken ashi candles. Number 1. Strong uptrend. In a strong uptrend, we have a set of bullish green candles with no lower wick. The body of each subsequent candle gets larger and larger. This shows that the uptrend is gaining momentum and is a good time to enter buy trades. Number 2. Weak uptrend. When the uptrend starts to weaken, the bodies of the green candles begin to get smaller with each subsequent candle. Sometimes, we also see lower wicks start to appear. This is a sign that the uptrend has lost momentum, and the trend might see a pause or a reversal very soon. During such times, a trader should look to exit their buy trades. Number 3. Sideways trend. After the trend weakens, we might see a set of doji candles. One individual doji candle can be a sign of momentum loss, but if we see a set of doji candles, they tell us that the price is in a sideways trend. Number 4. Strong downtrend. A strong downtrend can be identified when we see a set of bearish red candles with no upper wick. The body of each candle starts to get bigger and bigger. This shows that the downtrend is gaining momentum, and it is an excellent opportunity to enter sell trades. Number 5. Weak downtrend. When the downtrend gets weak, we see a set of red candles where the upper wick starts to appear, and the bodies of the candles begin to shrink. This is a sign that the trend is losing momentum, and we may see a momentary pause or a reversal in the trend. Now let's look at some examples that combine these signals with other price action factors to develop trade ideas. Trade examples. On this chart, we see that the price reversed from this area, so we mark it as a support level. The next time the price comes near this level, we expect the price to reverse again and move upwards. Soon enough, the price arrives near the support level again. This time, we look closely at the candles. In this particular down move, initially, we saw a set of red candles with no upper wicks, but the bodies were not increasing. They were decreasing at first. It shows that the down move was not strong at all. Then we have a red candle with a small upper wick. It is also a sign that the downtrend did not have any momentum. Next, we see a doji candle with a large upper and lower wick. And the doji candle has appeared at the support level. It shows that the support level is working just fine, and now there's a high probability of an up move from this point. Finally, we see this solid bullish green candle with a big body and no lower wick. This is a strong sign that the price is going up from this point on. So, a buy trade could be initiated from this candle. The stop loss can be placed below the candle, and the target can be set at the next resistance. Here is a sell trade. We see that previously, the price reversed down from this area, so we mark it as a resistance level. Now, when the price returns to the resistance, we expect it to reverse downwards again. We see that the candle bodies start to get smaller and smaller. We don't see lower wicks on these candles, but still, the shrinking of the bodies is a sign of momentum loss. Then we see this doji candle with upper and lower wicks. Again, it is a sign of momentum loss. Finally, we see a red candle with a big body and no upper wick. This shows that the resistance is doing its job and the price will reverse down. So, we can place a sell trade at the close of the red candle. We can keep our stop loss above the candle and target this support area. Here is a breakout trade. Here we see that the price made an upside reversal around this area, so we mark it as a support. Now, when the price returns to this area, we expect it to find support again and move upwards. But we see that the price starts to create these small doji candles. It shows that the price is consolidating and the support is significantly less likely to hold. We might see a break of the support. Finally, the price breaks below the support with two large red candles. This was a sign that the breakout was strong, and we could expect a strong downward movement. So, we can place a sell trade on this candle. We can set our stop loss above the candle and target the next support. Here is a trade using the moving average. We have a 20-period moving average on the charts. The price traded above the moving average and the MA was sloped upwards. So we have an uptrend. We also see that the moving average has supported the price on pullbacks. This time, when the price pulls back to the moving average, we expect it to find support as well. We also have a support level stretching from the previous high. So, we have a confluence of the support level and the moving average in this area. We see two doji candles here that indicate that the downward momentum is extremely weak, and the price is very likely to find support. Then we see these two green candles that confirm our thought process and gives us a perfect trade opportunity. So, we enter a buy trade at the close of this candle. We can place a stop loss below the candle or the moving average. On this trade, we do not have a resistance level to target, so we can target a 1 to 2 risk-reward ratio. And this is how to use the heiken ashi candles for your trading. The truth about trading is that you must always look for multiple confluences to identify high probability trades.